Traditional trade finance and traditional supply chain finance is mainly looking at the strength of a buyer's credit and providing finance to suppliers around the world. The challenge with that, though, is that the banks are also going to be looking at the supplier's own financial strength. And the traditional part is that they will always look at what type of hard asset collateral they can obtain from that supplier. In particular, they're going to be looking for personal guarantees, often in the form of, let's say, a mortgage on a house or a lien on a house type of scenario, so that in the event that there is a default, what are the other assets that they can claw back on? And this is where we differentiate ourselves, because we're looking more at what are the stream of transactions that they have and looking at that continuation as sort of cash flow that then we have as collateral on that supplier. From a supplier perspective, they're getting squeezed on all different sides. And one of the other aspects is that the financing that was traditionally available from the banking institutions is also becoming more scarce. And that's because of all the increased bank regulations that have come about since the financial crisis. As a result, suppliers need a lot more help on their cash flow. And in particular, they're carrying more inventory because there's shorter production lead times, as well as their buyers are extending a lot of the payment terms. And because of that, we're now there to provide that alternative capital. In particular, we're starting at a purchase order level at the manufacturing time frame, so that the supplier has the funds that are available to pay for their raw materials as well as pay for the production. What this does in terms of helping the buyer is that it's really assuring the ability that that supplier can perform and can supply the goods. And the key thing for a buyer is making sure that they can get the right goods at the right time, at the right place, and at the right cost as well.
A lot of the challenges that our customers have, particularly in cash flow, is the fact that they have credit or they have lines of credit with their banks, but they're tapped. If they want to grow, if they want to make investments for expansion of capacities or any type of investments, they are tapped. So they're limited in their growth. Having the ability to have access to cash flow allows them to handle their day-to-day and still use those lines, release those credit lines so they can be used for those investment projects. What we do is particularly account receivable finance. So we will be able to fund invoices from the moment that the product is shipped. So from that moment on, the customer can receive payment in 24 hours and would not be subject to wait the 30, 60, 90 days that it will normally take for them to receive payment.
On the factory floor, they have a common set of information they work from. They work from the purchase order information. So for them, it helped to get them all on the same platform. So they're working to a same standard as well. So it really helped to harmonize the workflows with the factory and set a clear set of expectations around what the factories are doing and really what their commitment was to deliver to us.